Good morning. Welcome to this update for global stocks and commodities for the 19th of March. The markets reacted quite well to the Fed raising interest rates, which was very much expected, and that is in stark contrast to what we saw over the last 5 or 6 years, where even the discussion that the Fed might raise interest rates caused the market to sell off by 5 or 10% at a minimum. And when they actually did it, the market actually sold off a little more heavily than that. We're now seeing a completely different attitude in the market, and it not only took the Fed rate rise very calmly, but the market actually advanced as well and remains within a whisker of its all-time highs. So they're important things to take note of when the market reacts very differently on a big picture level to what it has done in previous years, and it's indicating that definitely sentiment is shifting in a number of ways. Now, last week I went into detail to look at why I didn't believe there was any near-term top in the market, and I went back and I looked at 2000 and 2008 market peaks, and I think pretty comprehensively demonstrated that the current market is really of no cause for concern. And if you didn't see last week's video, then please go and watch it, because it's, I think, one of the most important perspectives that I can give you. And one of the reasons that traders and investors consistently underperform or do far worse than what they otherwise would do over long periods of time is because their head gets in the way. They just lose perspective. They get inundated with a lot of the media garbage and the voices in their own head, and they just have the wrong perspective, or they're applying a short-term perspective to the market, and that causes poor decisions. So I think these sort of big picture perspectives are extremely valuable. And this week I just want to delve one step closer to that, and I want to look at where the market looked as though it had broken down in 2015. And for those of you that have been watching these videos for more than a couple of years, will remember that at the time I certainly said that the market was showing signs of changing character and breaking down, and that some remedial action should be taken. Let's look at that now, a year or two on in hindsight, and see if we could have come to a different conclusion. Now, with hindsight, the market has advanced substantially, or whether in fact that was the correct call and the correct action at the time. So let's go straight in and do that. Sorry, just get the right screen. There we go. So we'll start with the S&P 500. That's where we're at the moment. This has been the reaction to the Fed. We had a little bit of a short-term dip. We got down to the 20-day moving average, and that support is held, and the market's still in very positive mode. But what I want to do is go back and look at this period through here in 2015. So as you know, what I look for is significant changes in character of the market. And coming out of the 2011 lows, you can see that the red line, which is the 200-day moving average, turned up. The price remained above it for a lengthy period of time. There were no really wild, volatile swings. And so the character of the market during that period was pretty well set. We then got a significant dip in October of 2014. Now, that in itself was not enough to take action, but it was just a little bit of a shot across the bows that maybe the character of the market was changing, and that a little bit more care should be taken. But really no action really necessary. But what that would have said to me is to be very careful about new buying, because if you remember back to what I said last week, our objective is to not try and buy the bottom 10% or to avoid losing the top 10%. What we want is the 80% in the middle. So if you go reacting to every little event like this, then it's going to make that task a bit hard. However, if you at least ceased your buying or significant raising of exposure in late 2014, then you would have done yourself some significant favors. You would have captured an extremely good run up. The S&P would have comfortably run from something over 1300, and at this point we were sitting just under 2,000. So we're looking at about 700 points of gain on the S&P. So that was October 2014. We then rolled on. The market remained fairly calm, but then we got a breakdown in August of 2015. And at that point, I think you can say definitively that the character of the market is changing. That was a very sharp dip. It went deeper under the 200-day moving average than what we had seen in quite a long period of time. And then the price stayed below that 200-day moving average, which had then in itself rolled over. So clearly, if you did not see this period as a bit of a warning sign that the market may be topping, we didn't have confirmation, but it may be topping, then clearly you just weren't paying attention. So the market managed to regain above that moving average. It then spent a few more months. So this was, let's just go back and recap. This is August 2015. We didn't get back up to new highs until about October 2015. So that all took several months. We then got another breakdown in January of 2016, and that corresponded to the Fed raising rates for the first time. And we did get a breakdown, and if you remember back to what I did last week, we broke the significant swing lows, which was this low here, and so that was a valid point for you to start winding back exposure. And that's in fact what I advised not only members but also the general public through this video at the time, that you should be starting to wind back exposure. We then got a little bit of a rally back above that breakdown point, which again is not abnormal. We then broke down again. So this period, January to February 2016, if you, again, and let me say, if you hadn't taken some sort of remedial action in reducing exposure, then you just weren't responding appropriately to the signals the market was giving. Now, that turned out to be a false breakdown. And from time to time that happens, but that doesn't mean that you shouldn't at least take some steps to reposition yourself. So my view is, even with the benefit of hindsight and the fact that the market managed then to rally from around 1900 and we're now at almost 2400, that I believe was still the correct course of action. So you would have wound back some exposure, but then once we got back to here, which was late February 2016, and clearly we were above this previous high, the late January high, then you could say, well, this breakdown's a false one, and we're off to the races again. And in fact, that's what's happened, and the market has just continued to advance throughout that period. So clearly, my view is that was the correct decision to make. We had initial strong evidence of a change in character. We got confirmation of that change in character. However, the confirmation failed. So you would have wound back at some exposure. You could have then gone in and re-added that exposure. And overall, providing you'd been playing this picture correctly on a big view level, then you shouldn't have done too much damage. So where are we at now? Well, clearly you can see the red 200-day moving average line is still robustly higher. The 50-day is still widening out from the 200, which indicates acceleration. The 20-day is above the 50, so and it's widening out. So everything is in alignment. This is a strong uptrend. Make no doubt about it. This is a very, very strong uptrend, and the moving averages are telling us that. So just if you're reading stuff about how we're close to a market top and the market valuations are at record highs and this is going to happen and the sky's going to fall in, then just stop doing it, because it's totally misleading you. This is all that you need to look at. The trend is up, all the indicators remain strong, and that's really the long and the short of it. So let's move on and take a look at what actually happened in the markets. The current market status is that there is no recession in sight in the US and not elsewhere around the world, really. Yeah, there's some pretty lackluster economies, but there's also some economies that are still expanding. Germany's doing okay. Certainly the US is doing okay. So there's no global recession in sight, and the stock indices are still strong, and they're showing no sign of rollover. And if you look at the German DAX, you look at the FTSE's just broken out of a 10-year consolidation zone, so it looks like it's going to push higher. The Chinese Shanghai market is looking good. So there's really no signs of weakness at that level. The only case at the moment, and this is really for shorter term traders, is really just a case for tweaking. It's just prudent periodically to trim excess weightings. Investors might want to consider doing this as well. If you've got a position that you've been in for several years and it's become too large in size relative to other positions in your portfolio, then maybe you should consider trimming that. You may want to raise some cash from sectors that have become a bit overbought, that have advanced very strongly, and therefore perhaps subject to some short-term profit taking. And then just look at recycling it into oversold sectors or oversold stocks. Now, if you're a long-term player, you don't have to do this. You can just sit with what you've got. But if you want to make more efficient use of your money, then this periodic recycling from overbought sectors, taking profit and recycling it back into oversold sectors that have got good upside, then that's just a better use of capital. It just exploits the natural rotation of the money that goes on in the market every day of the week. Now, last week, this was the main point that I made. Don't try and get the first or the last 10% of a bull market. You really can't be done. You'll completely mess yourself up if you try and do that. Just focus on the 80% in the middle, and clear your mind of all the garbage that you read in the media. Be decisive, keep it simple. So to wrap it up, your task to protect what you've got and to continue to leave the door open for more profitability is that you wait. So this is your checklist for the long term, and this is not easy to do. It's very simple, but it's not easy to do, and you've really got to have gone through probably a couple of decades of cycles to really be able to stand back and see this clearly, because not only is it a matter of recognizing it, you've actually got to have the inner confidence to go with that. And that inner confidence only comes from just a long period of time of exposure to different cycles in the market. So this is the checklist. We wait for confirmation of a turn higher when an index or a sector is coming out of a bear market. But you've got to be decisive to start buying. Now, I say within the first 10% there. Of course, you don't know that it's the first 10% until hindsight. But what I mean by that is that once you've got confirmation that the price is now turning up and the character of that market has changed from bearish to bullish, then be decisive to start buying pretty soon after that. Don't wait until everybody starts to acknowledge that a new bull market has started, because then you've lost a heck of a lot of your edge. Continue to do that. Stop buying once the market character changes, as we saw earlier, and that's really just a matter of following the chart, not following the media. And be open-minded enough to respond once we get confirmation of a top. When the character of the market gives us a warning sign, that warning sign is generally every bit of 3 to 6 months before the actual final breakdown occurs, and then respond to that. American stocks, the S&P was higher by 5 points, so we haven't had a lot of movement now for nearly 3 weeks. The short-term support's held, and the next move, you've got to say, is got to be, or not got to be, but is most likely upwards. You can't interpret the current chart any other way. And there's no reason why 2017 can't be another positive year, despite what so many people are claiming. First of all, valuations are not a problem. Secondly, earnings and profit margins are solid. Profit margins on average in America remain at around 12-13%, which is near all-time highs. Some people have been using that as a justification for why the market's going to top. because profit margins are at all-time high. I mean, that's the most ridiculous justification that you could dream up. You should be looking at that as a positive. The US economy is okay. It's not fantastic in all respects, but it's okay. And I think the main point is, and I'm going to cover this at the end, the relativity to other forms of investment is still attractive. The stock market is offering a more attractive risk-adjusted return than do bonds or property or any other form of investment. And that's really all you need to know, because that's where the money's going to go. Aussie stocks, the Aussie dollar finished at 77.1 thanks to a weaker US dollar and stronger commodity prices. The index was up 24 points for the week. It's possibly on the cusp of a breakout after a long period of time, but that's only going to happen if the banks do so. And as you know, I don't pay much attention to the ASX 200 because it's just so heavily a reflection of what the banks are doing. Let's turn to precious metals. Gold rose $25 on the week to 2030. GLD holdings recovered to 834, so some money flowing back into the ETF sector. It's not unusual that some money came out of it, of course, with that sudden move down in the gold price, but money's readily gone back in again. That's a positive sign. And we're also seeing premiums in the physical market in China and India. So buyers in China and India are prepared to buy physical gold. They're prepared to pay a premium over the futures market price. Now, stocks led the way down over recent weeks, but as I noted last week, had started stabilizing and did improve. So there's a positive sign. Now, I just want to look at the question, is this the normal start to a bull market? The first half of 2016 looked screamingly like this was going to be an amazing rally. It was the fastest and strongest start to a new bull market in gold that we never seen. But since then, the second half of 2016 deteriorated, and I think it's worthwhile looking at where we're at now. So from my perspective, if you look at the gold price, the pattern that we're seeing there is a bit inconclusive. And I'll deal with that when I get to the charts, the best way to show you. When we look at gold stock indices, they are better. They've got a better price pattern than the gold price has got, but they're a bit sloppy. They're that real strength of trend that we saw in the first half of 2016 has certainly got a bit untidy, but certainly the potential for a significant multi-year rally has not been negated. It's just a bit sloppy at this stage. So let's jump in and have a look at some of those charts. So we'll look at gold first of all. And let's take a look at gold on a big picture view. So we peaked out. This is a weekly chart on the gold price. So we peaked out with a massive excursion above. This is the 150 periods. So this is a 150 week or 3-year moving average. So it's a very big picture one, and we just got to an absurd level above that moving average in 2011. Pulled back into a big consolidation and then broke down from that consolidation very emphatically here in 2013 with just smashed through that support level at just over 1500, and from there it was into a pretty vicious bear market. Now, once the price found some stability, it turned up, and at the time I put a Fibonacci scale on this to see how far it might run. And that scale has remained on this chart. I haven't changed it since then. So this was when the market started turning up, which was when we started first forming a new high, and that was in early February 2016. So there was no guessing of the bottom here. I waited until we got some more positive action. That price scale set the first resistance level at 38.2, which was at 13.77. The gold market advanced to an exact high. Let me just get the cursor right there. To an exact high of 13.76, so within $1 of that resistance point. So the market behaved perfectly. It peaked out in July of 2016. I then put a retracement scale on the rise from here to here, and that gave us various levels, which the first two were broken. I expected the 61.8% at 11.76 to hold. The market ran beyond that for another 2 weeks and got down to 11.20. But we did have a bit of a perfect storm. So this was at the end of 2016. We had the perfect storm of Brexit, and then the Trump election, and then of course the Fed, talking about raising interest rates, and in fact raising interest rates at the end of December. So that was really the perfect storm that made gold less attractive. So we did get a bit of an overrun. We did form a higher high though, so all was not lost at that stage. Now at this point in time, we've rallied back from there. It's been a reasonably decent rally. We've pulled back a little bit, but I really can't say at this stage in the short term whether gold will go immediately higher or lower. So a bit inconclusive. But let's go and look at GDX. Oh, just sorry, before I finish with that, let's just look at the daily. So here we are on a daily chart. So I've now put a scale on this little run. So here's the 38.2. We exceeded that. Here's the 50, and so far we've held it again almost to the dollar. Came down here on the 10th of March, and then we've bounced. So where to from here? Hard to say. Let's just let it play out. Now let's turn to GDX. So this is the big picture with GDX. This is on a daily chart. So here was the big sell-off throughout 2012, 13, and then we had a little bit of stability for a while, broke down, GDX got down to 12, and then we started turning up. So you can see here at this point, the price was now above the red moving average line, the red 200-day moving average line. We had a nice bounce. We got no retracement. The moving average line started to turn up. So it was very clear by March that we had a pretty substantial rally on our hands. We went up, of course, to the previous peak, which was here in August of 2013. So that was a natural point of resistance. And if we also put a Fibonacci scale on this and run it up to the 2012 highs, then you can see that, sorry, let me just go back a bit higher because that wasn't the peak. Okay, here's our peak in 2011. That's better. Okay, so there's our 2011 peak, and a bounce to the 38.2 would have come in at 33. It encountered some resistance at 32, so that's pretty close to my way of thinking. So far, the GDX market is behaving well. Big picture, it's gone to 38.2 or thereabouts. We've had a pullback. That pullback was to the 61.8% of this run. So that's so far held very nicely, and now we're bouncing a bit from there. So gold stocks looking more positive, still not totally conclusive. I really want to see this high get taken out. So I want to see GDX trading above 26. Once I've got that confirmation, then I'll feel a little bit more comfortable. So the new bull market scenario is not being negated. but it hasn't exactly been confirmed yet either. It's been the case that we saw in the first half of 2016 has been weakened a little bit. I don't think anyone can argue much with that. But has the bull market been negated? No, it hasn't. Turning to other commodities, copper rose to 269. That was mostly about currency. Crude oil steadied, rose a little bit, about 30 cents. Have energy stocks bottomed? I don't know. There may be more downside, but what I suspect is that oil stocks have been sold off more heavily than oil, which is normal. They're going to lead the way. They seem to be finding some stability. So I wouldn't be surprised if we're not that far from a bottom in energy stocks, but I would absolutely wait for confirmation because another leg down is possible. There's the spot copper chart showing a nice recovery there. So to wrap it all up, and this is a perspective that's based on fact. It's not based on emotion. It's not based on the media. It's not based on some sort of gut feeling. The fact is that around the world, money flows to where it's treated best. And that's really all that you need to think about. Forget all the other stuff. Forget about, historical valuations and this and that. All you need to know is that money's going to go where it's treated best. And at the moment in the US, the earnings yield, so this is not the dividend yield, but this is the total profitability of the company. The earnings yield is around 5% on average for the S&P 500. The 10-year bond sits at 2.5%, so there's a 2.5% differential. And the very short-term bonds are at 0.5%. So if you've got a pot of money and you could put it into bonds and get 2.5%, but very likely lose a portion of your capital, because I think the signs are that the 35-year bear market in yields and bull market in bonds is finished, and so therefore we're entering a period where you're going to lock in a poor yield and probably lose capital. So would you rather put your money in bonds, or would you rather put your money in the stock market where you've got an earnings yield of 5%? To me, the equation is an absolute no-brainer, and that is what the market is doing. So, stop absorbing all this other rubbish that's out there. That's really the thing that you need to look at. Money's going to flow where it goes, where it's treated best. So the process that you should be focusing on is start buying once there is confirmation of a turn higher, whether that's at an index level or a sector level or a stock level. Buy the dips, so keep adding exposure. Buy the dips in sectors where the fundamental drivers look the most assured, and I talked about some of those last week and in previous weeks. Stop buying when the character of the market changes, and start to cut your exposure back. And then fully exit the longs on confirmation of a breakdown. Now, occasionally that won't work. We saw that in 2015. We would have exited on confirmation of a breakdown, and then a few weeks later we would have been starting to rebuild exposure. That happens. Nothing in the market is perfect, but what if it had been the start of a new bear market? You would have been very thankful that you'd exited your longs. So be responsive to changes in the market. So hopefully that's a really clear perspective for you. And for non-members out there, there's my contact details. As I said at the start of this video, all this stuff is relatively simple if you can just clear your mind of the garbage. But the problem is it's extremely difficult to clear your mind when you're not confident about what you're doing, and confidence only comes from decades in the market of just having been through the cycles, having been beaten up enough times and done the right things enough times so that you can retain a clear-minded perspective. And that's really the function that I'm trying to fulfill, is to provide that perspective, but hold some hands along the way. So for non-members, if you would like some assistance, then there's my contact details, and let's see what I'm sure another fascinating week will bring. Cheers.